Ways to build, improve, and repair your credit. Are you interested in getting mortgage ready? And do you realize that your credit is so important? Not only does it affect your affordability, but it can also affect the rate that they're willing to give you. So let's get started. What I'm going to show you today is the top 5 tips to get the most impact as fast as you can on improving your credit. So let's get started. My name's Manda. I'm the mortgage coach, and I've helped hundreds of people improve their credit, get on the property ladder, because I'm also a mortgage advisor and a financial coach. So let's get started. I don't want to waste anybody's time. Number 1, register. Register on the electoral roll. The reason that's important is lenders really want to know where you live. I know it sounds a bit creepy, but if they're going to lend you hundreds of thousands of pounds, and depending on where you're buying, it could be hundreds of thousands of pounds. They want to know where you live, and they want to know where you've lived for a certain amount of time. So register by registering to vote. That puts it there. Now, I know a lot of people, and I'm not going to get into politics, but I know a lot of people don't want to vote. You can register to vote, you can register on the electoral roll, and you can opt out for voting. That's not a problem. Or you can still get your voting card and just not vote, but register to vote. It's one of the top things that will give you instant credibility, and in some circumstances it's improved your credit score by about 50 points, so it's definitely worth doing. The second thing is checking your credit report regularly. Now, there can be errors, there can be, there's identity fraud out there. It really is important for checking your credit report on a regular basis. I would suggest Check My File. The reason is it's a multi-agency credit report. Now, what I mean by that is there are three credit agencies. There's Experian, there's Equifax, and there's TransUnion. And the thing about it is anybody you borrow from have a committed expense to. So that could be credit cards, loans, mortgages if you have one, car finance, buy now, pay later, buy a sofa, paying 3 installments, catalogue payments, anything like that, where they've given you credit, so you've got something and you haven't fully paid for everything up front. That is when you have a credit commitment, and they will report them to the agencies, but they don't have to report it to every agency. In fact, some don't always report it at all, which is another story. But by getting Check My File, you have got the option of seeing all 3 credit agencies' information, so that can be really, really useful. By checking through it, I'll do a video on how to check your credit file properly, and but basically you need to check it on a regular basis, and if you see any differences, then obviously investigate the differences. Check that everything seems like it's the right information. If you've got an address there that you've never lived at, go to the credit agency and make sure that's removed. Make sure that all the information is correct. The next thing is, and it sounds logical, but just to put it out there, make sure that you pay your bills on time. Make sure that you haven't got late payments, you haven't got arrears, you haven't got missed payments, because they do count against you, and they do really sort of bring down your credit score, which also affects whether you can get a mortgage or not. Everybody wants that 999 credit score, and I'll explain to you in another video when it's not actually about the credit score. Obviously, the credit score can indicate how healthy your credit report is, but it's more to do with your credit report, because lenders do their internal credit scoring. So that's one thing to know. The next thing is reduce your existing debt. Now, what I mean by that is there's 2 things to look at. There's your debt to income ratio, and then there's your credit utilization. Your debt to income ratio is, say for example, you're on £25,000. They don't expect your credit limits, so that's the limit on your credit card, the limit on your overdraft, any loans you've got outstanding, anything like that, to be over, in this example where you're on 25k, to be over that 50% of that, which is 12.5k. Now, when I say credit limits, I do mean the credit limit. So if you've got a credit card that is for 15,000, you're already over your debt to income ratio. You may only have a balance on the credit card of 5,000, but the fact that you have access to £15,000 worth of credit, it will go against you when you're going to apply for a mortgage. The next thing is credit utilization. They always want you to be in that 30% band. So what I mean by that is, in that example, if you had a credit card, say for £10,000, and you're maxed it out, for example, then you'd be over the credit utilization. If you've got a balance of £3,000 and you've got a credit card and you've only got one credit card, then that would still be in the right amount of credit utilization, because it would only be 30%. Now, if you've got a credit card for, say, £10,000 and one for £5,000, then the £10,000 the balance needs to be 3,000, and the £5,000 the balance needs to be 1,500, which is obviously 30% of that. I mean, when you add them together, as long as in total they are only 30%, then that's fine. So if you've got more on one card than the other, but in total it's that 30%, then you're also good to go. So I hope you guys have found this useful. Please like, subscribe, and I'll be coming back tomorrow to talk about more credit and other tips on how to improve your credit. So I hope you enjoyed it. By all means, any questions, put them in the comments and I'll reply to you. Thank you.